What's up, owner investor? In this video, we are going to estimate annual returns. Um, so now that we have gone back to this Airbnb example, now that we've kind of calculated the diluted EPS, we can look at the share price, and then the shares outstanding, and then that'll give us the market cap, and then net debt, and then this is the total enterprise value. Okay, so as we stand in 2023, the share price of Airbnb, Airbnb stock, $132.35, $135. Dollar sign action, cool. Then let's look at the shares outstanding. That'll be in the latest quarterly filing. All right, 217.85, 217.85 plus 412.4, 412.4 plus 9.2. All right, $84 billion. Let's just kind of double check that with, Google Finance, Yahoo Finance, or something. I'm just going to use ticker.com since I have it open. Again, like we're not trying to be super precise here. It's not like what matters is just being accurate. $83 billion. Okay, all right, that's close enough. If you're working for like a bank or something, and this is going to a presentation for a client, yeah, like you need to be much more precise, but that's not really what we're trying to do here. So we can be accurate and not waste a bunch of time. So $8.3 billion of net cash minus 883. We'll just use 8258 minus 8258. Our good number. Bottom border. Okay, so there's like $8.3 billion. Like, remember, this business just like spits out cash, right? So, um, like, it's, I mean, it's a wonderful business. It doesn't really take up a whole lot of capital because it's, the growth is really just financed by the customers and the suppliers, right? Like the actual like working capital, they only have like 185 million in receivables, like 283 in prepaid expenses. This 7.77, a lot of that is like we have here. Yeah, short-term investments. Yep, yep. So funds. Oh, did I include that in this? Capital. Oh, I did not. Um, hmm. Oh man, I'm sorry. I think I used like the wrong numbers. So I'm sorry about that. So the working capital actually for Airbnb is 7760 plus 515 minus 12212. 12212. Okay, so the working capital is still negative. Property, plant, and equipment is like nothing. We don't want to include the cash. Okay, so 122, 138. These are all different for some reason. Okay, so 122. Property, plant, and equipment. We don't care about the goodwill. Other assets, 207. I guess maybe this intangible assets we can just include it just to be a little bit conservative. Um, because that might include like capitalized R&D and stuff. So just usually if I had the time, I'd kind of go into a little bit more detail, but it's not really going to move the needle here. So it's $1 billion of net fixed assets. I'm going to ignore this like lease liability, lease asset, 122, 627, okay, and then 7760 plus 515 minus 12212. Okay, cool. All right. So it's still like negative invested capital, which is great, right? Like we can see like this increase, but that means this is just going to be like kind of a confusing accounting thing I don't really want to get into right now, but it just means that the business doesn't require like reinvestment to grow because the suppliers and the customers are providing that working capital, right? So what's great about that is that means that Airbnb should be able to start paying a dividend or repurchase stock soon. So we can see that, right? They bought back $493 million in shares, but they also issue a lot of shares in stock-based comp, change in funds payable and amounts paid to customers. Interesting. Okay, I'm not familiar with that line item actually in accounting. So see, so like this might be something that I might have to come back to, but I just want to show you kind of the mechanics of how to calculate returns. So okay, so this is the share price. So then we can kind of calculate what the multiple's at right now. So 44 times earnings for 2023 is, but remember there's like cash in here. So this isn't quite apples to apples, but I just want to see what this looks like. Okay, so, well, so, all right, 44 times earnings, but it's actually the economic multiple is lower because there's a lot of net cash here. Um, but basically the idea is like growth, like like the stock price equals the earnings per share times the PE multiple, right? So to the extent that the company doesn't pay any dividends and all of this earnings that was generated over the next 10 years has to be reinvested in the business to achieve this growth, then the calculation for returns would be really simple, right? So let's just say in 2032, this thing trades at like 25 times, which again, this is a huge assumption because it's going to matter where like inflation is in 10 years, where interest rates are in 10 years. So, this is something that, you want to you want to be conservative on, right? And you want to kind of sensitize this, plus or minus like 5 turns. And again, this is why we diversify, right? Because it's like there's a lot of uncertainties when it comes to investing, right? So let's just say $35.57 of earnings in 2032, and it trades at 25 times. That means it's an $890 stock in 10 years, right? This is 10 years of forecast. Okay, so this is okay. So it is including 2023. This is saying 2023 is going to be year one. So actually what we're going to do is, that's fine. Okay. So that means that the stock price going from 132 to 889, that means, it would be a 6.7x over, why don't we just extend this out one more year? Extend this out one more year. Insert column. here. Okay. So 1,113, 8.4x over 10 years, 1 divided by 10 minus 1. So that would be a 24% annual return, right? So this is what I really wanted to get to, which is how to translate. See, in less than 30 lines, what we've done is we've translated business performance, which is like the growth in the TAM, the growth in the market penetration, whatever, the margins, all this stuff into stock performance, right? Which is like this, right? So like if these things happen like somewhere around like the ballpark of these kinds of growth rates and these kind of margins, you can expect at least a 24% return, because again, Airbnb doesn't require all of this earnings to be reinvested into the business. So you'll get a 24% return if this plays out. Again, not financial advice. I have to keep saying that. In just the growth in EPS, net of the multiple compressing from 44 times to 25 times. Right, so this is the PE multiple. But the reality is you're going to get a lot of this, like the business actually generates cash as it's growing. So, a better way to do this would be to show you how to do this. Just so that, because for Costco doesn't generate that much yield. Yeah, like Spotify doesn't either. Neither does Basic. Okay, so if you actually look at the cash flows of what this would look like, right? You would pay $132.35 today, and then Airbnb. Let's just say they spend all of this EPS on share buybacks. So you're getting it in the form of share buybacks or dividends over time. And then you're also getting at exit, you're going to be selling, that single share at $1,113. Plus, you're going to get this $44.50 in the form of either share count reduction up here, or through dividends, right? And in terms of stock-based comp, for people that are kind of familiar with that, we're already subtracting that out, right, in this OpEx number. So we don't need to. That would be double counting if we also reduce the share count or increase the share count. But the reality is what's actually going to happen is Airbnb is going to issue some shares to its employees as part of like equity compensation, and then they're also going to buy back some stock, right? But right now, we've already deducted that dollar amount. Like you can convert that into a dollar amount using like Black-Scholes formula. It's like really complicated. We don't need to get into all that. Again, this is all like we're going for accuracy, not precision. So if this is like what happens over the next 10 years, right? What we can do is we can calculate the IRR, internal rate of return, and that would be like 28%, right? 24% of which is coming from just the growth in earnings per share, net of the multiple compression, because like the multiple will compress over time because like companies trade at high multiples when they're really stable, predictable businesses, and or when there's a lot of growth left, right? So like in 10 years, there's going to be less growth in Airbnb than there is today. And it's already pretty well known that it's like a good business, right? So it really just comes down to like what growth happens and what the kind of economics are, right? Like how much of that growth and revenue actually flows down to earnings, and then what multiple it trades at. These are the things that'll, so we'll call this annual returns. So this is like kind of what we're getting to, and this is the number you compare with like the S&P 500, like the 10% in S&P, 8%, 10% S&P. Unfortunately for Airbnb, I don't think we won't be able to use this valuation spreadsheet. We'll use it for Costco, but not Airbnb, because they have this like negative invested capital situation where the business like generates capital as it grows. And then what will happen is like when it starts to decline, it'll start to use up capital, right? So it's a double-edged sword, right? So if you're looking at a declining business that has negative working capital, that's horrible because it's going to suck up a lot of cash as the business unwinds. And then if you're looking at a growing business that has negative working capital, it'll generate cash as the business grows, right? If that's too confusing right now, don't worry about it. It took me a while to kind of grasp that concept, and if we can address it in one of the Q and A's, or you just post a question in the comment section, and I'll try to clarify it a little bit. But this is the end goal that we're trying to get to, right? And then, so in the next video, we'll kind of talk about like how to flex like these assumptions and see how like sensitive the returns are to the assumptions that we make. But for now, that's it. And as always, comments, questions below. I'll see you in the next video.